Good afternoon and welcome to another edition of Trade Talks. My name is Lyanne Alfaro and joining me today is Lance McGray, Managing Director, Head of ETF Product at Advisors Asset Management. Thank you so much for joining us, Lance.
Thanks for having me.
And it's your first run here on Trade Talks, so welcome.
Exactly. Thanks for having me.
So tell me a little bit, we're certainly not shy on the headlines nowadays. Could you tell us your view on the second half of 2018?
Yeah, exactly. The first half has certainly been not shy on headlines, whether you're looking at a lot of the tensions that we have in geopolitical risk between Russia and China and North Korea and potential trade wars and tariffs that essentially pop up every single day. There is definitely a lot of negative news out in the environment, but it's also important to look on the positive side. We had a 4.1 GDP number last week. We have unemployment at all-time or historic lows, and there's a lot of positive things going on in the environment, in the economics. Manufacturing is coming back. We have tax regulations that are sort of, definitely letting off on the smaller companies. And just as important is we have deregulation in the environment, which is allowing a lot of companies to essentially grow, which they haven't been for a few decades now.
Let's switch gears a little bit and get your thoughts on a major problem facing, in particular, baby boomers and millennials regarding retirement. So AAM works a little bit with like hundreds of advisors daily. What are you hearing from these advisors in terms of these roadblocks, perhaps, that are being faced?
No question. Retirement is a major issue for a lot of investors, not only baby boomers, but also millennials, as you would expect, who are just starting their career or going into college. And what is shocking to us is if you look at a lot of the reports that have come out over the last few years, over 55% of baby boomers, again, baby boomers, not millennials, have not started their retirement savings yet. And if you look at the millennials, the number is a little better, but still, millennials are not grasping it, where I think it's about 42% of millennials have not started investing for their retirement. So the question is, why is this happening? And I think it's pretty simple to see. Take the millennials, for instance. They come out of school with a tremendous amount of student debt. They go through an education process with hopes of landing that big-time job, making a lot of money. Unfortunately, a lot of millennials come out making less than their parents did in the same type of job scenario. So now they're making less money, they have more debt, they can't afford a house, they have to rent, rental prices increase, and they have no money to save. Unfortunately, something has to give, and in many instances, it is the retirement savings of millennials and baby boomers, which essentially are hurting right now.
Where do they end up? Well, how does this turn out if they don't have this money to expend?
Exactly, and that is the million-dollar question. And there are three things that you can essentially do, right? High level, three things that you can do. You can make more money, you could save more money, or number three, which we think is a perfect area for us to step into as an asset manager, which focuses on income products, is to invest your money more efficiently. So in 10 years, in 5 years, in 20 years, or even 40 years, in the sense of some millennials, they are essentially where they need to be to meet their retirement goals.
So is that then your advice to investors who may have retirement on their mind?
Exactly, and we just went through all of the topics that are sort of headline risk right now. But in reality, when you're talking about millennials and even baby boomers, sometimes it's worthwhile to have the blinders on, if you will. The trade talks, the tensions, the booming economy, those are all short-term events. And when you need to look at your retirement savings, you need to look down the road. How am I positioned right now, and how do I get to where I want to be in 20, 30, 40, or even 50 years?
Absolutely. Now, shifting gears a little bit again, AAM just launched 2 ETFs in November, so congratulations. What makes these products different than other dividend ETFs, and how can they help investors achieve their retirement goals that we're just
That's a question we get all the time. Lance, why did you get into the dividend space in the ETF arena? There are over 40 dividend ETFs just that focus on U.S. equities. And my response to that is, we are an income solution shop at Advisors Asset Management. That is what we do. It's in our DNA. We've been doing it for 40 plus years. And over the last year, we did a massive in-depth analysis of all the dividend ETFs that were currently listed in the US. And what we realized is they can essentially be placed into two buckets. The first is a high dividend yield bucket, where that portfolio is expecting to create alpha based on the fact that historically, high yielding equities have outperformed low yielding over the time. On the second bucket, you have dividend growth, where that group of strategies is not necessarily looking at the high yield, essentially, of that dividend, but it's looking at for the compounding through the ability for that company continue to pay its dividends. So it's looking for dividend growth. And what we realized over the year is working with some of our partners is that those two goals don't have to be mutually exclusive. You can offer a high yield while also offering dividend sustainability, and that's exactly what our high dividend value suite of ETFs does. And we are awfully excited to launch it, both products, SPDV and EEMD, listed on November 28th of last year.
Wonderful. Well, Lance, thank you so much for joining us and talking to us a little bit about these issues and how you're addressing them. And we hope to have you back soon.
Thanks for having me.
All right, Trade Talks followers, stay tuned for more from Trade Talks right here on Twitter. Signing off for now.